Now that global physical exchanges have become sufficiently liquid to benchmark a real supply gold bullion price outside the CME LBMA ring fence, the stealthy gold revaluation process that commenced directly after the Bank of International Settlements revalued gold as a first-tier high-quality liquid asset on the 1st of January 2023 has gathered sufficient momentum to force the US Treasury gold to be revalued. There it is. You can start to see it. And as we've been drawing attention to, every single non-dollar denominated fiat gold price has led dollar denominated gold into all-time highs. So every other gold price in every other currency has been making new highs long before dollar price was dragged higher. But as we've been focusing on, the real game changer is that China took the gloves off the moment that yuan gold became fully Basel III compliant.
According to Andrew Maguire, a seasoned whistleblower and precious metals expert with decades of experience uncovering market manipulation, these factors may lead to a formal revaluation of U.S. Treasury gold. With COMEX shifting from a price maker to a price taker, it seems that the days of suppressing synthetic paper are coming to an end. The disparity between paper and physical gold has shifted to a tipping point, which could result in a sharp increase in the real price of gold soon. The current state of the gold market has the potential to change the financial landscape of the entire world. There is growing evidence that the Federal Reserve has been forced to repurchase leased gold at ever-increasing prices after becoming entangled in large, short gold derivative positions. The Fed's increasing susceptibility to a possible worldwide gold revaluation is demonstrated by data from COMEX footprints. The market structure is being altered by Basel III changes, and the outdated paper-based system of price regulation is being further strained by the rise in physical demand from China. Be sure to like, subscribe, and hit the notification bell for more insights into gold, silver, and precious metals investing. Share your thoughts on the market in the comments below.
Yet to be repaid US Treasury lease positions. We'll drill into the detail of how vulnerable to a forced gold revaluation this presents the Fed. And we're going to do that shortly, but the far more visible COMEX futures positions. Now, this is the spot market. So let's look at the futures market, which is really apples to apple. Every single month, we evidence how deep a hole the Fed has dug. Now, this is best demonstrated by the sequentially higher end of month and now yesterday's here end of third quarter mark-to-market event. This time, despite a massive effort to rinse out as many spec longs as possible into yesterday's end of quarter, we saw an attempt to rinse out. So basically, to try and mark that down, the bottom line is the Fed was forced to buy back deeply underwater gold leases at exactly $409 per ounce higher than they could last month. Now, given there's still 30 tons to buy back at market, it will drive the offer price to sell gold even higher. So if I'm a seller, I'm going to, and I see this demand coming through, then I'm going to raise that price. It's the Fed that's on the hook for the remaining asymmetrically imbalanced short bets against gold, and having no physical bullion to back up those short bets, and having not anticipated that the COMEX has been forced to become a price taker, the only solution is to once again buy back this borrowed gold at the market price ahead of an impossible to avoid gold price revaluation. And as we just evidenced, currently, this will cost them over $400 an ounce, more than last month's BIS repayment. Following a good deal of healthier skepticism around our assertion that the Fed must revalue gold, it seems we're not alone anymore in assessing it for all the same reasons we previously outlined, as picked up for the first time here by Bloomberg on Monday, and also picked up by Zero Hedge alongside other mainstream media publications we're not going to bother to dig into at this point. As we summarized in our last episode, this relentless bricks gold demand has driven the legacy paper market into an impossible to maintain divergent inflection point that can only be resolved by one of two events: a massive bid only T+1 margin call, meaning it's going to be delivered right away. That can only be resolved. So either that way And that's would spike gold, as we said last time, thousands of dollars higher. Or, of course, much more equitably resolved by a more orderly US Treasury gold price revaluation. Now that global physical exchanges have become sufficiently liquid to benchmark a real supply gold bullion price outside the CME LBMA ring fence, the stealthy gold revaluation process that commenced directly after the Bank of International Settlements revalued gold as a first-tier high-quality liquid asset on the 1st of January 2023 has gathered sufficient momentum to force the US Treasury gold to be revalued. There it is. You can start to see it. And as we've been drawing attention to, every single non-dollar denominated fiat gold price has led dollar denominated gold into all-time highs. So every other gold price in every other currency has been making new highs long before dollar price was dragged higher. But as we've been focusing on, the real game changer is that China took the gloves off the moment that yuan gold became fully Basel III compliant, followed by opening up Western-facing institutional-grade gold trading and vaulting facilities, which eliminate unallocated gold counterparty risk. Hey, no-brainer there. And with that in mind, and obviously you need the right liquidity to do that, but with that in mind, with the SGE market holiday coming up, now there is a market holiday, and it starts today. Now, drilling down even further, illustrating the SGE has now overtaken Loco London as the global price setter, the relatively small 3 to 5 tons of Basel III compliant London spot gold that settles at the fixes is actually dwarfed by the 15 to 50 tons of SGE gold physically withdrawn every day. Now, recently, we've evidenced these volumes ramping up fast, hitting record volumes as high as 53 tons, entering warehouses at the end of the day. This gold is flowing into China at the expense of the legacy cartel. Now, these footprints illustrate that the SGE global bullion trading hubs have become sufficiently liquid to discover 2 competing institutional grade Basel III compliant physical fixes. That's Beijing time 10:15 a.m. and 2:15 p.m. That enables the diluted Loco London twice daily fixes to be one-to-one arbitraged as a benchmark. Now, the clues are all there. Each Asia buys physical COMEX sells paper session, and we see multiple examples of it, AM fix versus a PM fix. Now, we have seen some change in behavior, but usually it is Asia buys and the West sells. And again, we've seen, although we see a break in behavior here, it's simply because the shorts got squeezed more than they could cope with. And again, we see a new high being made today, Wednesday, and then the PM fix coming in lower. All that does is set up China for an Asia to set up a bid-only situation, which we saw after the sell-off. Okay, so China's on holiday, but the PBOC certainly is not. And as I say, ETF demand will not stop. It's only just begun. Now, let's look at why CME margins, meaning the cost to borrow 100 ounces of a gold contract from the house, currently is $17,000 per contract. Now, let's look at why they have not raised these margins from a value of 280,000, which is 6.07% of the value of 280,000. And why? And I haven't even marked the latest highs here. I just recorded this yesterday. That was 390,000 per contract value. And the CME margin was still only 17,000, which is only 4.3% of the value. Now that raises the question, why have the CME, essentially, why has the CME not raised gold borrowing margins into the subsequent, now bearing in mind that we talked about how speculators buy and you want to knock them back down, you want to take the with impunity add short positions against them, and then raise the margins, and they're so leveraged, they simply have to sell. Beggars the question, what's different now? So the Post-Basel III gold first-tier reclassification on the 1st of January 2023 had driven a 970 rally from 1,830 into the 1st of November 2024 at 2,800, prompting the CME to raise GC borrowing margins on that day. And this margin increase, as I say, targeted heavily leveraged longs who'd borrowed gold from the controlling COMEX cartel, triggering a 2-week $260 sell-off. As I say, why has it not raised since? Because you're talking a $1,300 gold price appreciation, which just this week
Silver is about to embark on a major structural repricing phase. The COMEX, which was formerly the world standard for precious metals, is currently being compelled to act as a price taker. In order to safeguard the substantial naked short positions that are still in the market, silver futures margins stay constant, even when demand and volatility soar. Global supply is getting tighter in the meantime. Since silver was recently designated as a vital resource, nations like China, Russia, and even the United States are hoarding it at previously unheard of levels. The market is under more strain due to geopolitical tensions and possible export restrictions, which are highlighting the paper silver system's limitations. China's active stockpiling has contributed significantly to the artificial undervaluation of silver, denominated in dollars, when compared to record highs in other currencies. With the return of Western institutions to the market, every decline is promptly absorbed, pushing futures and spot prices to multi-decade highs. Make sure to like, subscribe, and click the bell icon to get notified whenever we upload new content. We really appreciate your support.
Shane, every time I see you, mate, I see silver in your eyes. I actually see that. So, yes, let's have a look at that. For all the same reasons, silver futures margins have not been raised to protect the very large naked, officially short bets against silver. Now, with COMEX now reduced to becoming this price taker, the only solution to buy this silver back at market is to buy it back at market. But hey, Houston, there's a problem. Isn't that a saying? Houston, there's a problem. Silver has just been classified or reclassified as a critical mineral. Now, into really very, very escalating geopolitical and tariff escalations, it's in very strong Russian and Chinese military demand. Now it's in US demand. I mean, basically, that's why we're noting record prices in every single global foreign exchange currency cross, prompting the US to both accumulate, and the word is soon to ban exports of US silver. There's only one outcome to tightening supply. The offer to sell silver for immediate delivery is simply going to rise. Let's look at a similar look at the silver futures structure. For all the same reasons, they haven't raised margin calls. And you think about it. Take a look at this, which is a protection of very large, naked, official short bets against silver. And with COMEX now reduced to becoming a price taker, the only solution is to buy this silver back at market. As I say, here's the problem. And as we just noticed, silver's just been reclassified as a critical mineral. And with it in accumulation with Russia, China, and the US has just begun, probably likely this export ban is almost certain. As I say, there's only one outcome to tightening supply. The offer to sell silver for immediate delivery simply has to rise. So, at a contract value of 165,000, and this was the same period, 2020, when they raised margins on silver to 16,000. Again, we saw a bit of a smackdown there. That was 9.7% of the 165,000. It's still 16,000, and we've actually moved higher now. So basically, even though it's slightly higher now, there's still 6.7% of contract value, which is a hell of a lot less. Now, shorter term, as silver broke out above the identified short stops at 44,275, if you remember, we circled this. I've now added color to that circle, but this is where the circle is, as is this circle at 53. But essentially, it broke out last Thursday. Then we saw UBS belatedly updating their silver spot price to between 44 and 47 per ounce, stating it would bring it in line with their upgraded 3,900 gold forecast made a couple of weeks ago. They also reaffirmed their intention to stay long and would view all pullbacks as buying opportunities in both gold and silver.
In the silver market, Andrew Maguire pointed out a significant turning point. He clarified that the margins on silver futures have not been increased in order to safeguard the extremely sizable naked short bets that are still holding against the commodity. Purchasing silver at the present market price is the only method to cover these bets because the COMEX is now functioning as a price taker rather than a price maker. Due to the recent reclassification of silver as an essential mineral and the enormous accumulation of the metal by major players such as China, Russia, and now the United States, the supply is drastically constrained, posing an increasing challenge. This pattern is supported by recent market action. There are currently over 370 tons of October silver contracts that are not deliverable being summoned for physical delivery, and an additional 82 tons are still outstanding. As a result, short positions need to be covered, which raises prices. The Fed is currently on the losing side of this transaction, holding short positions without enough real silver to settle them, Maguire underlined. With supply limited and demand high, silver is poised for a major revaluation that will drive prices to new all-time highs. In conclusion, the market for silver is facing tremendous pressure due to intense physical demand, tightening supply, and unparalleled worldwide accumulation. This is a structural change rather than merely a transient surge. According to Maguire, as physical demand continues to dominate, shorts are forced to cover, and the outdated paper-driven system finds it difficult to regulate the market. The dollar price of silver is expected to rise significantly. If you enjoyed this video, don't forget to hit the like button, subscribe to our channel, and turn on notifications so you're always up to date. Thanks for watching.